$250 is the minimum you're going to pay a financial advisor for what I'm about to tell you for free. There's like a bajillion different types of accounts you can invest your money in. Nobody ever tells you the correct order that will maximize your gains and minimize the amount of tax you pay. Financial advisors are known for gatekeeping this information and then charging an arm and a leg for it. Then they'll use confusing terms to overwhelm you and make you think that there's no way you can possibly do any of this yourself. And that's what we're covering in this video, the correct personal finance order of operations. These are the basics that everybody skips because they're trying to get rich quickly generally. I can promise you though, if you stick with these foundational steps, you will win with money. If we're meeting for the first time, my name's Patrick. I'm a certified financial educator and I do twice weekly videos on how to make and keep more of your hard-earned money without the confusing and salesy BS typical of the financial industry. If you find this information valuable, make sure you smash that like and subscribe. It really helps me out and helps get this life-changing information out to as many people as possible. So without further ado, let's get into the personal finance order of operations. The first place to put your money is your oh shit fund, aka an emergency fund. Bad stuff is going to happen that you can't foresee. Your car is going to break down, your kid might break their arm and have a $2,000 emergency room visit, your water heater might go out and you have to fork over $1,500. I use that example because that just happened to me personally. And that's why you have to have your oh shit fund of at least enough to cover your insurance deductibles, because otherwise when things like this happen, you're using a credit card to pay for it and then you're just digging yourself a deeper and deeper hole. A good place to keep this oh shit fund is a high yield savings account. Bank savings accounts pay something like 0.05% interest, so you're literally losing money to inflation if that's where you're keeping it. A high yield savings account is a federally insured online bank account that earns 4% or more guaranteed. There's a million to choose from. Make sure you do your own research. I'll leave a link for the one that I recommend down below in the caption. Step 2 is the closest thing to free money that there is in existence. You work a job, you likely have a 401k, 403b, or 457. Don't get confused by the terminology. All these are retirement accounts you put your money in. You buy investments within these accounts, and then you're taxed less on the money. A quick aside, an index fund that tracks the total stock market, like stock symbols VOO or VTSEX, are the most effective ways to invest for beginners. Buy these within all these accounts I'm mentioning. This gives you ownership of the best companies in the world, like Microsoft, Apple, Tesla, without having to buy all these stocks individually. Over the last 100 years, this method of investing has averaged 10% per year. Back to the 401k. Many jobs give you this match that I mentioned for contributing to a 401k because they get a tax break from the government, and it gives you good reason to stay at the company longer, as this is free money that goes away if you're not vested. Meaning if you stay with an employer for a certain period of time. Let's just say, for example, you make $50K and your employer matches your 401k contributions up to 5%. So in this example, you put in $2,500, your employer also contributes $2,500, and instant 100% return on your money. This is one of the most underrated wealth building hacks out there. I cannot emphasize this enough. You are leaving free money on the table if you're not taking advantage of this. Credit card debt is step 3. In the United States, there's now over $1 trillion in total credit card debt. That's an average of over $6,000 per household. And with credit card interest rates over 20% for the first time ever, you're basically taking out a loan at 20% interest if you're not paying this off every single month. Put that into perspective, mortgages used to be 3%, and people are freaking out about 7% interest rates now. Credit cards are at 20%. This money you're putting towards your debt, you could put that in the stock market, but there is no investment in existence that gets a guaranteed 20% return. And if somebody tells you there is, they're trying to scam you, point blank. Putting money towards this credit card debt is the only place you can get a guaranteed 20% return. As far as debt payoff methods, I like the debt avalanche. This saves you the most amount of money over the long term. This involves listing out debts in the order of highest to lowest interest rates, and then you pay off the highest one first. Step 4 is the Roth IRA. Another fancy name, but don't get worded off by this. It's actually very simple. It's a retirement account you open on your own. Fidelity and Vanguard are both great providers if you're a beginner. I personally use Fidelity. I just find them the most user-friendly. You buy investments within these accounts, think the VOO or VTAC. Think of this account like a basket you put your investments into. You contribute up to $6,500 a year in this account, but make sure you actually buy investments. A Roth IRA is an account and not an investment in and of itself. Like I said before, buying an index fund that tracks the US stock market like VTSAX in this account is going to be the best long-term bet to grow your money. Best part of this account, any gain on your investment is not taxed down the road when you go to withdraw it. If you're like me and you think taxes are going up in the future, this is a great way to protect yourself. Step 5 is one of the best kept secrets in personal finance. The money you put in is not taxed. The money you take out is not taxed as long as it's for medical expenses, and the money can be grown and invested tax-free within this account. It's commonly referred to as a triple tax advantage account, the health savings account. It's an amazing way to save for medical expenses and grow your money at the same time. In 2023, you can put up to $38.50 per year into this account if you're single. Usually people have one of these through their employer, but if they don't offer one, you can also open one on your own through a provider like Fidelity. A quick word of caution, a health savings account comes with higher insurance deductibles, meaning if you do go to the doctor or emergency room, it's going to be a little bit more expensive. So if you're someone, or if you have someone in your family that uses health insurance a good amount, or if you have some kind of chronic health condition, skipping the health savings account and opting for traditional copay insurance may be a better option for you personally. For step 6, we're going back to the 401k. You can put up to $22,500 a year into this account, max that thing out. The final step in the personal finance order of operations can be a number of things. Maybe you want to pay more towards your mortgage. Maybe you want to put money towards your child's college savings account, a taxable brokerage account, which is essentially a regular stock market account. Again, not sponsored, but Fidelity and Vanguard are a good opt for this. And if you don't want to do any of those, you can also do real estate, crypto, anything your heart desires once you fulfill the first 6 steps. The issue is a lot of people will skip right to real estate or other investments in lieu of doing the other things. There's people that will tell you only do real estate. What they don't tell you is that this is not a passive investment. Tenants will break things. Some won't pay rent. We'll have vacancies. You have to replace a water heater, like I just said. We also had to do an HVAC unit this year to the tune of $10,000 to $15,000. That's for one property. Imagine doing that for 10. You need a lot of cash set aside in order to float yourself when bad times in real estate do inevitably come. See 2008. That's the down and dirty of the personal finance order of operations. I also have a free investing cheat sheet that lays all of this out in a readable format. I'll leave a link for that as well. Thanks for watching. Again, if you found this valuable, make sure you like, subscribe, and share this with a friend. And follow Basic Financial Literacy for more tips on how to make and keep more of your hard-earned money.